I'm Brent Joyce, Chief Investment Strategist at BMO Private Investment Counsel. It's Groundhog Day, Friday, February the 2nd, a day to celebrate all forecasters, even the furry kind. Welcome to 2024's first installment of our Global Markets Commentary. The central thesis underpinning our views is that the world is returning to normal. But when it comes to investing, normal always comes with a normal level of uncertainty. The economic trends in January were a continuation of familiar themes: strength for the US economy and US stock markets, and malaise for the Chinese economy and China's stock markets, while the rest of the world muddles along. Thankfully, inflation across the globe continues to trend favorably. While the trend is favorable, the job is not yet done. Most developed equity markets added to the gains that closed out 2023, with special mention that the S&P 500 crested to a new all-time high. The stellar performance from stock markets in 2023 and new all-time highs to open 2024 may have some worrying that we are inching toward the precipice of a significant decline. As long-term investors, we don't see it that way. Stock markets have made thousands of all-time highs throughout their history. It is a part of their existence and not a reason to panic. Would it surprise you to learn that between the drawdown of 2022 and the recovery last year, the S&P 500 has only compounded at an annualized total return of 2.4%. That is well below the expected long-run rate of return from stocks, which is closer to 12%. Some stock markets may be ahead of themselves in the very near term, but stepping back, we continue to see equities in a favorable light. One market that did get ahead of itself is the bond market. Back in December, the US Federal Reserve signaled that 2024 might bring interest rate cuts, sending bond yields sharply lower. January brought some right-sizing to that enthusiasm, with bond yields moving back up a bit. The overall theme hasn't changed. 2024 will likely see central banks cut rates, but the timing has been moved out and the degree of cuts has been pared down a bit. We think rate cut expectations might need further reduction. The bond market is still priced for 6 interest rate cuts in the US and 4 in Canada. We see 4 in the US and 3 for Canada. Finessing the timing and extent of cuts is a balancing act between economic growth, inflation, and wage growth. And all of this has implications for stocks. If economic growth is stronger than expected, earnings growth expectations will rise. That's good for stocks. But central bankers might not cut interest rates as deep, which tempers some enthusiasm in the stock market. Conversely, if economic growth is weaker, earnings expectations will need to soften. That's bad for stocks. But under weaker growth, one would expect slower wage growth and lower inflation expectations. And in that scenario, central banks will likely cut interest rates more than expected. And that's a plus for stocks. So it's earnings growth on one side and the level of interest rates on the other. How this teeter-totter plays out on share prices depends on how closely each variable matches current expectations. The good news is many of these variables are returning to normal as the bullwhip effect from COVID-era shakeups continues to fade. Today, the level of uncertainty surrounding possible outcomes is narrower and more focused than the past 4 years. Investors are trying to parse how much the economy will grow, not when there's going to be a recession. Will inflation land between 2 and 4% versus the 6 to 9 of the past 2 years? Similarly, on earnings growth, the question today is whether earnings will grow 6 or 10%, not how much they're going to contract. Uncertainty is a constant in capital markets and investing. The amount of uncertainty kicked up over the past 4 years due to the pandemic has been historic. The fog and gyrations around many key data points fundamental to how investors value assets has been extraordinary. We are finally approaching a point where we can say things are returning to normal, emphasizing that when it comes to investing, normal still comes with a level of uncertainty. Weighing the probabilities, we continue to be constructive on the outlook for 2024 and see an environment where investors are rewarded across the risk spectrum. Our base case lays out favorable risk-adjusted returns from cash, bonds, stocks, and selected alternative strategies. That's the way we saw the month of January. Thank you for joining us. We look forward to you tuning in next month.